Section 2.1 to 2.3 Investment Considerations in Emerging Markets. 2.1 Market Size and Potential. Emerging markets exhibit considerable size and growth potential across key economic indicators such as GDP, population, and consumer spending. Here's an evaluation of these factors: GDP size and growth potential. Emerging markets collectively account for a significant portion of the global GDP. According to the International Monetary Fund, IMF, emerging and developing economies accounted for around 60% of the world's GDP in 2021. Some of the largest emerging markets include China, India, Brazil, Russia, and Mexico. These economies have demonstrated robust GDP growth rates over the years, outpacing the growth rates of developed economies. Although growth rates can fluctuate due to various factors, emerging markets, as a group, continue to contribute substantially to global GDP growth, population size, and growth potential. Emerging markets are characterized by large and rapidly growing populations. Many emerging economies, such as China and India, have populations exceeding 1 billion people each. The combined population of emerging markets represents a significant share of the world's population. This population size not only creates a vast domestic consumer base but also provides a labor force that can drive economic growth through productivity and innovation. As these populations continue to grow, they offer a potential market for various goods and services, attracting investments and driving economic expansion, consumer spending and middle-class expansion. Emerging markets are experiencing a notable increase in consumer spending and the growth of the middle class. Rising incomes, urbanization, and expanding employment opportunities have contributed to higher levels of disposable income and increased consumer demand. This trend is particularly evident in countries like China and India, where the middle class has been expanding rapidly. The growth of the middle class creates opportunities for businesses to cater to the demands of a growing consumer base, driving domestic consumption and economic growth. Urbanization and infrastructure development. The process of urbanization in emerging markets is driving the growth potential of consumer spending. As more people migrate to cities, urban areas become centers of economic activity, offering diverse markets and employment opportunities. Urbanization also spurs demand for infrastructure development, including housing, transportation, and utilities, creating investment opportunities and fueling economic growth. Technology adoption and digitalization. Emerging markets have been quick to embrace technology and digitalization, presenting opportunities for businesses to tap into digital markets. The rapid expansion of mobile internet access and smartphone usage has facilitated e-commerce, fintech services, and digital platforms in emerging markets. The adoption of digital technologies has the potential to accelerate economic growth, improve efficiency, and increase access to goods and services for a broader population. While emerging markets offer substantial size and growth potential, it's important to note that there are variations among individual countries within this group. Factors such as government policies, infrastructure development, political stability, institutional quality, and market reforms can influence the extent of growth and investment opportunities within each market. It is advisable for businesses and investors to conduct detailed market analysis and consider country-specific factors when assessing the potential of emerging markets. Several sectors and industries within emerging markets present significant growth opportunities. Here are some sectors that are particularly noteworthy: information technology and digital services. The technology sector, including software development, IT services, and digital solutions, is experiencing rapid growth in emerging markets. Increasing technology adoption, digitalization, and a rising demand for IT services offer opportunities for companies in areas such as software development, e-commerce, fintech, and digital platforms, consumer goods and retail. With the expansion of the middle class and increasing consumer spending, consumer goods and retail sectors have substantial growth potential. Rising incomes, changing lifestyles, and urbanization drive demand for a wide range of products, including fast-moving consumer goods, electronics, fashion, and retail services, healthcare and pharmaceuticals. As emerging markets experience demographic shifts and rising healthcare needs, the healthcare and pharmaceutical sectors are witnessing significant growth. Demand for healthcare services, medical equipment, pharmaceuticals, and healthcare technologies is increasing. Companies involved in healthcare delivery, pharmaceutical manufacturing, medical devices, and telemedicine are well-positioned to capture growth opportunities. Renewable energy and sustainable infrastructure. Emerging markets are increasingly focusing on renewable energy and sustainable infrastructure to meet growing energy needs and address environmental concerns. The development of solar, wind, hydro, and other renewable energy sources, along with investments in green infrastructure, presents opportunities in areas such as renewable energy generation, energy storage, energy efficiency solutions, and sustainable construction, financial services and fintech. The financial services sector, including banking, insurance, and fintech, is expanding in emerging markets. As access to financial services improves, there is a growing demand for banking products, insurance coverage, and digital financial solutions. Fintech innovations, such as mobile payments, digital lending, and digital wallets, are gaining traction, offering opportunities for both traditional financial institutions and new technology-driven players. Education and skill development. As emerging markets invest in human capital development, the education and skill development sectors are poised for growth. There is a growing demand for quality education and vocational training to meet the needs of expanding economies. Opportunities exist in areas such as K-12 education, higher education, vocational training, online learning platforms, and edtech solutions, infrastructure and construction. With rapid urbanization and the need for improved infrastructure, the construction sector is a significant growth area. Infrastructure projects, including transportation networks, housing, energy facilities, and smart cities, require substantial investments. Opportunities exist for construction companies, engineering firms, infrastructure developers, and providers of construction materials and equipment, tourism and hospitality. Emerging markets often possess rich cultural heritage, natural attractions, and historical sites, making them attractive tourist destinations. The tourism and hospitality sectors are experiencing growth as more people travel within and to these countries. Opportunities exist in hotel and resort development, travel agencies, tour operators, and related services such as food and beverage, transportation, and entertainment. These sectors represent some of the growth opportunities in emerging markets, but it's important to conduct thorough market research and consider specific country contexts and dynamics when identifying investment prospects. The attractiveness of sectors may vary across different emerging markets, depending on factors such as government policies, infrastructure development, and local market conditions. 2.2 Political and regulatory environment. Assessing the political stability and regulatory frameworks in emerging markets is crucial for understanding the business environment and potential risks and opportunities. Here are key factors to consider when evaluating these aspects. Political stability. Political stability refers to the overall stability and continuity of a country's political system. It involves factors such as the absence of frequent political unrest, smooth transitions of power, and a predictable policy environment. Political stability is essential for creating a favorable business climate, attracting investments, and ensuring the continuity of economic policies. Factors to consider include the country's history of political stability, the strength and effectiveness of institutions, and the presence of democratic processes and rule of law. Government policies and regulations. Assessing the regulatory framework is crucial to understand how government policies and regulations impact businesses and investments in emerging markets. Factors to consider include the transparency and predictability of regulations, ease of doing business, investment protection laws, tax policies, intellectual property rights protection, and the efficiency of bureaucracy. A stable and well-defined regulatory environment promotes business confidence and fosters a conducive atmosphere for investment and economic growth. Corruption and bribery. Evaluating the level of corruption and bribery in an emerging market is important as it can impact business operations and create additional risks. Transparency International's Corruption Perceptions Index provides insights into the perceived level of corruption in different countries. Understanding the enforcement of anti-corruption laws and the government's commitment to combating corruption is essential for assessing the operating environment, legal system and contract enforcement. The strength and effectiveness of a country's legal system and contract enforcement mechanisms are critical for businesses operating in emerging markets. A robust legal system, independent judiciary, and efficient dispute resolution processes ensure the protection of property rights, contract enforcement, and the ability to seek legal remedies if necessary. Analyzing the quality and efficiency of the legal system provides insights into the stability and reliability of the regulatory framework, regulatory risks and policy changes. Emerging markets can be subject to regulatory risks and policy changes. Governments may introduce new regulations, change investment policies, or implement protectionist measures that can impact businesses. Assessing the potential risks and monitoring the regulatory environment for any significant policy shifts or reforms is crucial for making informed business decisions. Political and social unrest. Understanding the potential for political and social unrest in emerging markets is important for assessing the stability of the operating environment. Factors such as civil unrest, social inequality, ethnic tensions, and terrorism can impact business operations and pose risks to investments. Monitoring social and political dynamics, media reports, and expert analysis helps evaluate the potential risks associated with instability, international relations and trade agreements. Consider the emerging markets' international relations, trade agreements, and geopolitical dynamics. Regional integration, participation in trade blocs, and bilateral agreements can enhance market access and trade opportunities. Assessing the country's relationships with major trading partners and geopolitical stability helps gauge the potential impact on business operations. It's important to note that political stability and regulatory frameworks can vary significantly among emerging markets. Detailed research, consulting country-specific resources, engaging local experts, and monitoring updates on political and regulatory developments are crucial to gain a comprehensive understanding of the business environment and associated risks and opportunities in each emerging market. Political and regulatory risks can have a significant impact on investment decisions in emerging markets. These risks can create uncertainty, increase operational costs, and affect the overall viability and profitability of investments. Here are some key points to consider regarding the impact of political and regulatory risks on investment decisions, investment stability and returns. Political and regulatory risks can undermine investment stability and affect expected returns. Sudden policy changes, regulatory hurdles, or political instability can disrupt business operations, impact profitability, and lead to financial losses. Investors assess the stability of the political and regulatory environment to gauge the potential risks to their investments and make informed decisions about the expected returns, business environment, and operational costs. Political and regulatory risks can affect the ease of doing business and increase operational costs for companies. Excessive bureaucracy, inefficient regulatory processes, corruption, and unpredictable policies can hamper business operations, increase compliance costs, and delay projects. Such challenges can erode profit margins and make investments less attractive. Legal and contractual security. Political and regulatory risks can undermine the legal and contractual security of investments. Weak rule of law, lack of enforcement of contracts, and inadequate protection of property rights can expose investments to risks of expropriation, asset seizures, or contract disputes. The strength of legal institutions and contract enforcement mechanisms is crucial for ensuring the security of investments and investor confidence. Market access and trade barriers. Political and regulatory risks can impact market access and create trade barriers for investors. Protectionist measures, import restrictions, discriminatory regulations, or changes in trade policies can limit market opportunities and hinder the free flow of goods and services. Investors evaluate the potential impact of trade barriers and market access restrictions on their investment plans and long-term business strategies. Currency and repatriation risks. Political and regulatory risks can create challenges in currency convertibility and repatriation of profits for foreign investors. Capital controls, exchange rate volatility, restrictions on fund transfers, and limitations on profit repatriation can affect the ability of investors to access their returns on investment. Such risks can influence investment decisions, particularly for those heavily reliant on foreign exchange transactions. Policy stability and long-term planning. Political and regulatory risks can impact the stability of policies and long-term planning. Investors seek predictability and policy continuity to make strategic investment decisions. If there is a high level of policy uncertainty or frequent changes in regulations, investors may adopt a cautious approach or delay investment decisions until the business environment becomes more stable and predictable. Reputational and social risks. Political and regulatory risks can also have reputational and social implications. Negative publicity due to non-compliance with regulations, involvement in corruption scandals, or association with politically unstable regimes can harm a company's brand and its relationships with customers, suppliers, and other stakeholders. Investors evaluate the potential reputational risks and consider the alignment of their investments with social and ethical standards. It is essential for investors to conduct thorough due diligence, assess political and regulatory risks, and develop risk mitigation strategies when considering investments in emerging markets. Engaging local experts, monitoring political developments, and staying informed about regulatory changes are crucial steps to navigate the potential impact of these risks and make informed investment decisions. 2.3 Macroeconomic factors. Analyzing macroeconomic indicators is crucial for understanding the overall economic health and performance of emerging markets. Here are some key indicators to consider when analyzing emerging markets. Inflation. Inflation measures the rate at which the general level of prices for goods and services is rising and, consequently, eroding the purchasing power of a currency. High inflation can have adverse effects on an economy, including reducing consumer purchasing power, increasing production costs, and destabilizing financial markets. Monitoring inflation rates in emerging markets helps investors assess the potential impact on investment returns and make informed decisions. Interest rates. Interest rates play a critical role in shaping borrowing costs, investment decisions, and overall economic activity. Central banks in emerging markets set interest rates to manage inflation, stimulate or cool down economic growth, and maintain stability in financial markets. Changes in interest rates can impact the cost of capital, influence investment decisions, and affect the attractiveness of investments. Investors analyze interest rate trends and monetary policy actions to assess the impact on investment returns and financing costs. Fiscal policies. Fiscal policies refer to the government's decisions on taxation, spending, and borrowing. The fiscal health of an emerging market is essential for assessing its ability to finance public services, infrastructure projects, and social programs. Investors monitor fiscal policies to evaluate the sustainability of public debt, potential fiscal deficits, and the government's commitment to maintaining a stable and conducive business environment. Exchange rates. Exchange rates determine the value of one currency in relation to another and can significantly impact international trade, foreign investments, and competitiveness. Fluctuations in exchange rates can affect the profitability of investments, import, export costs, and the repatriation of earnings. Investors evaluate exchange rate stability, currency risk, and the potential impact on investment returns when considering investments in emerging markets. Current account balance. The current account balance measures the balance of trade in goods and services, net income from abroad, and net current transfers. A positive current account balance indicates that a country is a net exporter, while a negative balance suggests a net importer. Monitoring the current account balance helps assess the external trade position of an emerging market and its vulnerability to external shocks and changes in global economic conditions. External debt and reserves. The level of external debt and foreign exchange reserves provides insights into a country's ability to meet its international financial obligations and manage external shocks. Excessive external debt or inadequate foreign exchange reserves can indicate potential risks and vulnerabilities. Investors consider the level of external debt and reserves to assess the stability of an emerging market's external financial position and its ability to attract and retain foreign investments. GDP growth. GDP growth rates indicate the rate at which the overall economic output of a country is expanding. Higher GDP growth rates generally suggest a healthy and growing economy. Investors assess GDP growth trends and forecasts to gauge the potential for investment opportunities and the overall economic health of emerging markets. Analyzing these macroeconomic indicators provides a holistic view of the economic performance and potential risks of emerging markets. It helps investors assess the stability of the investment environment, anticipate potential challenges, and make informed investment decisions. However, it's important to consider these indicators in conjunction with country-specific factors, such as political stability, institutional quality, market regulations, and sector-specific dynamics. For a comprehensive assessment of investment opportunities in emerging markets, central banks and government policies play a crucial role in shaping the economic landscape of a country. Here are key aspects of their roles and responsibilities. Central banks, monetary policy. Central banks are responsible for formulating and implementing monetary policy. They use various tools, such as interest rates, reserve requirements, and open market operations, to control money supply and manage inflation. Central banks aim to promote price stability, maintain currency stability, and support sustainable economic growth. Currency management. Central banks oversee the management of a country's currency. They may intervene in foreign exchange markets to stabilize exchange rates and prevent excessive currency fluctuations. Central banks also manage foreign exchange reserves to ensure liquidity and support the stability of the currency. Financial system stability. Central banks monitor and regulate the financial system to maintain stability. They oversee commercial banks, set prudential regulations, conduct stress tests, and provide liquidity support to banks when needed. Central banks play a crucial role in safeguarding the stability of the financial system and preventing systemic risks. Lender of last resort. Central banks act as lenders of last resort, providing emergency liquidity to banks and financial institutions during periods of financial distress. This helps maintain stability in the banking sector and prevents the spread of financial crises. Economic data analysis. Central banks collect and analyze economic data to assess the overall health of the economy, identify trends, and make informed policy decisions. They monitor indicators such as inflation, GDP growth, employment rates, and consumer spending to guide their monetary policy actions. Government policies. Fiscal policy. Governments formulate fiscal policies, including taxation, spending, and borrowing decisions, to manage public finances. Fiscal policies aim to achieve economic stability, stimulate growth, and address social and infrastructure needs. Governments use fiscal measures to manage public debt, fund public services, and promote economic development. Regulation and oversight. Governments establish and enforce regulations to ensure fair competition, consumer protection, and the proper functioning of markets. They oversee sectors such as banking, finance, healthcare, energy, and telecommunications to promote transparency, efficiency, and public welfare. Government regulations play a crucial role in shaping the business environment and protecting the interests of consumers and investors. Infrastructure development. Governments invest in infrastructure development to support economic growth and improve the quality of life for citizens. Infrastructure projects, such as transportation networks, energy facilities, and communication systems, provide essential foundations for business activities and contribute to long-term economic development. Social welfare and redistribution. Governments implement social welfare programs to address income inequality, poverty, and social challenges. These programs may include healthcare, education, social security, and poverty alleviation initiatives. Government policies aimed at social welfare and redistribution can impact income distribution and consumer spending patterns. Economic planning and industrial policies. Governments may develop economic plans and industrial policies to promote specific sectors or industries deemed crucial for economic development. These policies may include incentives, subsidies, and targeted support to stimulate investment, innovation, and job creation in priority areas. Central banks and governments work closely together to coordinate monetary and fiscal policies to achieve overall economic objectives. Their actions and policies have a profound impact on the business environment, investment climate, and economic growth prospects of a country. Understanding the roles and policies of central banks and governments is essential for investors and businesses to navigate the economic landscape and make informed decisions.